What are we going to cover today, Itai? What's all the good information that everybody's going to get to hear about from your lips today?
Yeah, so today is a little bit of a more of a general call. I know in some of the other market calls we did dive into specifics of where the market is in the right here and the right now, but this one is going to be a broader one that's going to cover some of the historical narrative of how do we actually even get to this point. And it may even go further back than, the normal 2020, 2021 we've been talking about, going back decades, and how policies taking that time are really causing shifts in the macro environment today. And then we're going to really cover about, okay, so we understand how did we get here? Where do we go from now? And we're going to give you some probabilities of that. We're going to talk about whether or not the Fed is going to pivot, and how does that going to look like? And then, the question that I've kept being asked, is this the end game? Are we going to finally see the end of this money printing era or not? And we'll try to answer that as well. This is our asset management view. So really, we're going to cover those 4 questions today, which is how did we even get here? Where are we now? When does the Fed pivot? When do we pivot, right? And is this the end game? So we are going to start with how did we even get here? I'm going to cover this very briefly as it is a pretty extensive period of time. And while we're talking about all of this, we're going to talk about this with the context of interest rates and how interest rates have been impacted by time and how Fed policy has changed with time. So really starting at the post-Bretton Woods world order. And for those of you that are interested in that, we did a 3-series extensive cover of petrodollar, which goes back to the Bretton Woods system, that goes into those historical narratives even more. But generally speaking, post-1944, we've been in a world that was all other FX were basically pegged to the US dollar, and then the US dollar was pegged into gold. And in 1971, the convertibility to gold was suspended by Richard Nixon, and effectively the US was off the gold standard. Post that, we've seen a period of pretty high inflation in the new fiat era, really stagflation in the 1970s, that led to really high inflation in the early 1980s, and Paul Volcker really coming in to rein that inflation in. That was the first time that the Federal Reserve really tried to rein in inflation as its primary goal versus necessarily the employment or the economy.
Got it.
Sounds familiar?
It sounds very familiar. Is this the first time that we've ever had this low of an interest rate environment for an elongated period in the fiat era prior to these interest rate hikes?
Yes, we've never been, well, the 1930s, you could argue that we're close to real rates, but in a more modern era, this is the longest we've been in the zero rate. And as you can see in some central banks, even below zero, up until now, 2022, really. So early 1980s, Paul Volcker decides to raise the federal funds rate to a stunning 20%. Imagine that today. And then
that's an unbelievable number.
It's an unbelievable number. And then inflation does end up collapsing, but it does trigger a recession in the early 1980s. Coming out of that recession, it was a pretty good time for economic growth, leading to the 1987 crash. Now, why is the 1987 crash important? Because it didn't lead to a recession. It was a market-only outcome. But during this time, Alan Greenspan lowered interest rates in response to a market move, to a Wall Street move, not a Main Street move. So that was really the first time that the Fed started caring really about Wall Street, potentially even to the detriment of Main Street. So the 1990s also had another period in 1997 where the Fed bailed LTCM, long-term capital management, which really what they should be called is short-term capital mismanagement, as that was closer to their strategy.
Yeah, that's right, and a very famous blowup. If you want to go back into the history archives.
That's right, and what's really interesting there is that the question of moral hazard, where why should we bail out the losers when it's capitalism. You make a mistake, you blow up. But the reality is, it just created a lot of systemic risk, and that decision really started the ball rolling to what ended up in 2008 where the Fed just intervened in everything, right? So now we had a bailout of banks, and we had quantitative easing, and we had all these things. And when you got to the zero bound, as you mentioned earlier, the markets were still not recovering, the economy was still weak, and it was just not enough. So they had to do something extraordinary, and that was the quantitative easing programs, which is really the printing of money in order to spike that growth, to create that growth. And we've been on that trajectory ever since, particularly doubling down during COVID. So what you can see here is that Fed balance sheet, starting in 2008, interest rates were already at zero. It was not enough. We've increased the balance sheet of the Fed. And every time, the QE programs were halted, we've had some sort of issue with the financial markets, whether it was the European debt crisis, it was volatility in 2018, and then you get COVID. And COVID really, this number almost doubles. And this is just stunning. 40% increase in M2 money supply, an unprecedented level of monetary and fiscal intervention.
So Itay, when you see a balance sheet this high, which now looks like it's somewhere in the range of, $9 trillion, does this ever go back down, or is it only up from here?
Well, that's what we're seeing right now. So in 2022, the Fed begins the quantitative tightening. So that's literally the opposite of everything they've been doing up until now. I think that in 2021, they recognized that they've been too easy for too long as a policy mistake, and they've started reversing that. And reversing that means increasing interest rates, but it also means reducing the balance sheet. So as of right now, they're reducing about $100 billion every single month.
In E-time, it might be worth taking just a quick step back of saying, one, how does money even enter the system in the first place? And then if it can enter the system, how can it just disappear out of the system? Just to make sure we can all be on the same page about that really quick.
Yeah, and I do think it's very important to understand, because this is really one of the new ways in which the Fed has been engaging monetary policy. So on one hand, it's creating money supply by buying US treasuries. So the Treasury Department issues US debt in the form of treasuries. And then the Fed creates money out of thin air with a click of a button, and then uses that money in order to buy those US treasuries. So when you see the balance sheet, those are actual assets that sit on the Fed's balance sheet. So these could be mortgage-backed securities, or these could be US treasuries that they're purchased typically from the US government. The US government pays the interest on those. And then as it matures, in the past, the Fed has reinvested those. But now the quantitative tightening, when it matures, you get back your principal plus your interest. The Fed just clicks the delete button, and that money just disappears.
Got it. So as it can appear out of thin air, it can also be deleted out of thin air, but there could be implications of this deletion, correct?
And these are those are really the implications, what you're seeing here. So we've been running a pretty strong correlation between the Fed's balance sheet and risk assets. So in this case, we're measuring risk assets with the NASDAQ 100. So we can really see the rate of growth here post the global financial crisis, kind of slow, but still pretty good growth. But then post-COVID, as the Fed balance sheet exploded, so did the returns of risk asset, predominantly things like crypto, things like the NASDAQ, things like these high-flying tech stocks. However, as the balance sheet started falling and interest rates have risen, it's had very poor performance in 2022, at some point down over 30%. And that really makes you wonder just how much dependent on liquidity all these risk assets really are.
Got it. So basically you're saying, hey, when money is in the system through QE, everything's all looking good. But the second that, hey, the money is being taken out of the system, well, then what does that mean for the greater market, correct?
Yes, and it's been a very challenging investment environment in 2022, really as a result of this.
Thanks.
Another thing that made 2020, 2021 different from prior instances, because you can argue, well, we've had QE since 2008. Why haven't we seen inflation? And it's really interesting, because up until 2021 and 2020, we've only had monetary policy intervention. So we just had QE, but we haven't had fiscal policy intervention. So what we've seen now is that the federal government used the money that they're getting from the Fed in order to transfer payment, unemployment insurance, stimulus packages, all these things while the economy was shut down. So what do you do when you get a bunch of money, but you can't really spend it because everything is closed?
You save.
You save. So
Correct.
we see this huge increase in the savings rate after the first fiscal stimulus, and then we see a second increase after the second one. But then what happens when everybody is flush with cash? You can see how much more savings you had from the trend. And then the economy reopens, but we still have supply side issues. And everybody's trying to buy everything literally the exact same time.
So is this graph, is this more of the economy's been closed, I just need to go do stuff again? Or is this a story of inflation in this graph where the things they needed to buy in the first place are just becoming more expensive and eroding their savings?
It's actually a mix of both. Because post the opening, we've seen inflation really tick up, and then it required more money to buy that. But also during this time, you couldn't really buy a lot of things because the majority of the economy was closed. So that combination of supply side squeeze plus all the fiscal and monetary policy is likely the reason we're getting this level of inflation. What's really something to note is the credit card outstanding debt versus the savings rate and how that developed post the reopening.
So this is actually really interesting because it looks like credit card debt outstanding is an all-time high. Is this factored into any type of inflation calculation? Because I know that carries a very heavy APR. And if you're already having inflation and more credit card debt, is that now a double whammy?
Mm-hmm. So far we're seeing consumption still rising, but also credit card debt. So that's really something we're watching for in a, if and when we get a developing recession, because the consumer spending is such a key part of the US economy that if the consumer spending starts falling, that's going to be something that we're definitely watching for.
And what's consumption, about 60% of GDP?
It's closer to 70, actually.
This is why we have you around to always make sure that we get our numbers correct.
Yeah, so it's a very important factor of the economy. As I mentioned before, 40% increase in M2 money supply during 2020 and 2021, just mind-boggling numbers. And the Fed really realized late 21 that they've made a mistake. Powell went to the Senate for a testimony in November, and he was saying it's time to retire the word transitory from the dictionary. That's when I was starting to realize that they're probably going to be a lot more aggressive than a lot of people believed. And that's really what they went on and did during 2022. And this is really how we got here.
So where are we now, Itay?
So financial conditions have eased. I'm not going to cover this much, but economic growth is expected to definitely slow. In some models, it's showing contraction, but it is expected to slow. And estimates for GDP are lower. And at the same time, the good news is there's also expectations for inflation to slow. And we're actually getting the inflationary numbers next week. I believe on Tuesday, we have the CPI data. And then day after, you get the decision of the FOMC regarding the last interest rate increase for 2022. I think it's most likely going to be another 0.5% increase. They've raised 75 basis points, multiple meetings in a row, which is really almost unprecedented, but they're most likely going to slow it down to 50 basis points this month.
Got it. And Itay, what we've seen for the past few months, has there ever been a time in US history where interest rates have gone up this fast in such a short window?
Yes, in the early 1980s, Paul Volcker.
Okay, great.
But not since. So it's been a while. It's been before we were born. Not to reveal our age by any means.
Well, you got to still study history, even if you weren't there for part of it.
That's exactly right. So CPI could still be sticky through the remaining of 23. And that's really one of the key things that we're watching for, because it's really, really important to see what inflation is going to do. Because if we do go into a recession and inflation remains sticky, it could tie the Fed's hands, and then that recession could be deeper than it would have been otherwise. And that's really one of the...
And what might be some of those catalysts? So let's say inflation comes in hotter than needed, then they need to keep interest rates higher. Now, all of a sudden, corporate refinances that have, need debt to service their businesses, they're paying more. Like, what are going to be some of the dominoes that you'll start seeing that higher interest rates could have an impact on for a forward-looking recession?
Yeah, so corporate refinancing is a huge deal. That's 6.7 trillion that needs to get rolled over next year. So imagine all these corporations sitting on low interest rates will need to basically refi their debt. Their cost of servicing that debt's going to increase, and earnings are going to deteriorate, which typically leads to layoffs. So that's just one factor of it. Housing
And the
sector is another
layoffs
big one.
could start force selling of real estate assets, which could then spark a downturn in the real estate market, which could also hurt bondholders on real estate. So there could be a number of cascading events that could potentially happen. Is that safe to say?
It's the vicious cycle. Yeah, it's a self-fulfilling loop as well. So that's one of the reasons that if typically during a recession, what the Fed does is goes back to easy money policies, and that really helps corporations and businesses and individuals really weather the storm. But if they're unable to do so and they keep interest rates higher for longer, even during a recession, that's exactly kind of the downside scenario that may unfold. So that's why it's very important to watch what inflation does, because that will allow the Fed potentially to go back to lower rates versus not. And services inflation is what's really, really important, because that's more sticky than the others. So commodity prices can come back down. So let's say if there's less demand for copper or oil, the price of copper or oil may fall. But once the price of a service goes up, imagine how many times have you seen the price of a car wash go down once it's already been up? Once car wash is now $15 instead of $13, does it ever really go back to 13?
No, but one of the things that's really confusing is why are services, the blue line, continuing to grow?
Yeah, because that's the stickiness of it. So initially, commodities and other factors go up, and then those cost increases get transferred into wage inflation. They get transferred into services inflation. So your plumber is charging more to do what they did before, and all these things. And then that's the most sticky type of inflation. So the longer the other type of inflation stays in, the higher the likelihood that services inflation starts becoming sticky, and that's really the main issue. It's actually even stickier than shelter. So,
Very
once that takes hold in the economy, that's why the Fed was so aggressive in trying to fight it once they realized what they did, is because they understand very well that services inflation is a very sticky part of CPI.
Thanks for that explanation.
Yeah, no problem at all. So retail sales are still strong and still above growth. And this is really the story of the two economies. It has definitely come down since COVID, but that remains fairly strong. And also the labor market remains very strong. So those are really the factors that are contributing, because the economic strength of the economy is still relatively there. But then at the same time, the increase of interest rates and the way monetary policy works in a lag, those are factors to be seen. So it's really inflation, it's consumer spending, it's economic growth, and it's employment picture. Manufacturing is already contracting, so a little bit of information there. So we are seeing some level of demand destruction and deterioration in the greater macro picture. And that leads us to what I think is the most important factor after accounting for inflation and the jobs market, is really the housing market. It's another huge sector of the economy, and it's very, very important to see what's happening in that, because this is one of the key drivers, not only of inflation, but also economic growth.
So Itay, what percentage of the overall assets held by Americans are in housing? And two, any commentary you have on what looks like a very stuck real estate market?
Yeah, so we know it's the vast majority of net worth is typically in home equity. It's, unless you're a part of the wealthier sector, if you're a middle class, and even upper middle class family, the vast majority of your net worth is going to be tied to your home equity. And even during prior recessions, sometimes access to HELOCs and things like that has allowed people to go through a hard time and pay back other types of higher interest debts and things of that nature. So what we're seeing in the housing market is complete freeze, and that's actually really interesting because looking back, it's rare to see this level of freeze, because in 0809 this freeze led to price drops, and very significant price drops. But we haven't seen that yet. We've seen very mild price drops so far.
What's the normal lag that you see from the adjustment in interest rates until when you start seeing some of the housing assets really change in price in terms of like a lag of months or years?
Yeah, so we've only seen that in the prior, 8 and 9. So I think it's difficult to draw a conclusion from one sample size because it's only been a few months and then we've seen price drop afterwards. But I think the factors of this market are different because in 08, 09, we've seen the jobs market deteriorate quite quickly, and there's also been all the famous, lending practices that we've seen in 08, 09. You could have gotten a mortgage on your dog if you wanted to, and things of that nature, right? They weren't doing a lot of credit checks, and there's a lot of subprime mortgages involved, and we don't have that today.
So my 8-pound Pomeranian is going to be getting a smaller mortgage than your 60-pound German Shepherd, correct?
If it was 2007, right?
Ah,
But
okay,
I don't think the banks allow for dog-based mortgages anymore.
Okay, all right. I'm glad things finally came to their senses.
But other things too is that home equity is much higher, much stronger. So most owners today are sitting on substantial equity in their homes. Most owners would have 40-50% equities in their homes today because of appreciation and having locked low rates and things of that nature. And if you think about it, if you have a job and you're making okay money and you're sitting on a loan of 3% on your home, you have virtually no incentive today to sell and trade into even a better home and a bigger home, because with the new mortgage rates, you just simply can't afford it, right?
Correct.
So sellers are sitting on their hands because they're not willing to lower their price because they still have to move to somewhere else. But buyers can't afford it at all. This is right now, I think, the worst affordability in the US history.
Okay, so Itay, then what's going to be the straw that breaks the camel's back here? What's going to cause the housing market, either prices to dip or pending home sales to start going up again? Like, what are you looking for?
So there are two things that can happen. The more bullish scenario would be that the Fed is able to pivot and mortgage rates start dropping and unemployment somehow remains low. So then the housing market may get back to life without having significant price depreciation. So that would mean inflation would peak, and the Fed would be able to lower rates. The other scenario is we go into a pretty deep recession, or we go into a recession, companies started laying off people en masse, because right now, you don't have motivated sellers. You only have, some divorces, some, natural life factors.
Life events, yeah.
But what if you start getting millions of layoffs? Then it's no longer, well, maybe I'll sell. It become, oh, I have to sell. I can't make my mortgage. And that's when supply is going to flood the market, and that's when prices may fall.
Got it. Okay.
So another factor to watch for 23. So that leads us to that next question about the Fed pivot. Is it going to happen? Right now, what's interesting is that the dot plot. So if you're not familiar with this chart, each one of these dots represents where each member of the FOMC thinks rates are going to be in certain timeframes. So that's 22, that's 23. Look how volatile things get into 24. It's all over the place. So Fed is pretty unison thinking, okay, in 23, rates have to stay high because we need to really crush this inflationary problem. And then in 24, it's literally all over the place. And the market itself is trying to just take the average of those, maybe a little bit on the high side, but there's really no conformity of opinion of where rates should be going into 24 because the Fed themselves has very little idea of how economic data is going to come out.
In that white line of what the market's expectation is this just looking at the yield curve right now?
It's the Fed funds futures.
Okay, Fed funds futures. Okay. Overlaid on top of where each of the dots being each of the members of the FOMC that would have a deciding vote on where these interest rates go?
Yes, that's right.
Okay.
So we are expecting a lot of economic volatility because the reality is we just have very little idea of what kind of economic data is going to come out and how it's going to look like. How quickly is inflation going to come down? How's the labor market going to respond? There's just a ton of uncertainty going forward right now. Nonetheless, the Eurodollar curve is showing that the Fed is going to pivot around June. But what does a pivot actually mean? A pivot would mean that they're going to stop raising rates. That's probably going to be the last time they're going to raise rates.
Okay.
And the question is, once they start cutting rates, are things going to start turning back up or not, right?
Correct.
And the answer is it depends.
I kind of knew I was going to get one of those type of answers right there. All right, teach me why it's going to depend.
So when we looked back into it, we saw that there were, as of recent history, there's been 6 instances of these type of events leading to recession in 3 different occasions and no recession in 3 other occasions. So at some points, the Fed cut was actually enough to narrowly avoid a recession because the economy was slowing down, but not slowing down enough for a recession. Then the Fed starts cutting rates, then things turn back up again. So you can see that in the blue line. That was 95, 98, and 2019. In these 3 instances, despite some yield curve inversion and other metrics, not to the degree we have today, markets did rebound quite a bit because we avoided a recession. However, in 89, 2001, and 2007, these are the two more recent ones, the Fed cut was actually not enough. We were too little, too late kind of event. There was too much damage done to the economy already. Things were decelerating, and even with the rate cuts, markets still went on to a prolonged bear market.
So it really does depend.
It really does depend whether or not the cuts would be enough to avoid a recession. And that leads us to that last question of the end game. And what does that really mean? Is that kind of the end of the money printing game, or what is really the potential scenario of how things can play out? So I'll cover the Fed's base case and what a lot of market participants think. They think that we will have this softish landing, which means that because employment numbers remain very strong, unemployment is very low, because there's still strength into the economy, the belief is that we're narrowly going to, either if we do get a recession, it's going to be a very mild one, corporate balance sheets are strong, etc. That's kind of the argument. And we don't really go into a full-blown recession. It's more like very slow growth or zero growth for a while. We digest all these factors. The economy does not collapse, and inflation collapses. Inflation just drops very quickly. And because inflation drops very quickly, the Fed is able to cut rates more aggressively. We narrowly avoid the worst case scenario. And risk assets will do okay under this scenario, and things would generally, the worst would be avoided. That's what the Fed is attempting to do.
Got it. But more importantly than what the Fed is attempting to do is what does Kramer think about which of these landings is going to happen, and how can we do the exact opposite of that as fast as possible?
I think Kramer, as of last that I know of, is in the softish landing camp.
Okay, so this is for sure going to be a hard landing.
we fall more into the hard landing camp. We think that because monetary policy works in a lag, because we have this corporate refinancing taking place, we do believe that unemployment will rise, things will start deteriorating, but at the same time, inflation is going to slow as well. Maybe not as fast as the Fed would like it to. So we do think we're going to get this mid-level recession scenario in 23. The yield curve seems to support that hypothesis as well. However, we don't have all the bad lending practices we've had in 2008, 2009. We have a relatively solvent banking system today. And there's more risk management and oversight when it comes to a lot of these things. So we think that it's going to be a mid-level recession. We don't think it's necessarily going to be as bad as 08 or 09. So what's really the difference between that hard landing and a catastrophic landing? Take everything I just said and then add contingency risk and full-on banking crisis to it. So that hypothesis would be there's some kind of FTX somewhere in the normal Wall Street banking system that we just don't know about, and something in that high debt and high interest rate environment, obviously not a good mix, is going to cause that to blow up.
Could some of the factors of what's happening in Russia and Ukraine right now, could that impact how some of these scenarios play out from your point of view?
Yeah, I mean, you could have, we do have a slide on the end, but you do have international factors. So imagine something in Japan or something in the European Union. Let's say right now if there's a very cold winter, they run out of natural gas, that causes an even deeper recession and some kind of banking crisis there too. But and inflation remains relatively high, so they can't intervene too much. So that's obviously a possibility. But in order to get that catastrophic scenario, you really need a banking crisis. So you need banking insolvency, you need global contagion risk, currency devaluations, things of that nature. I think it's unlikely, but it's definitely possible.
Okay. Good to know. I'm excited to see that later slide.
So again, talking about a recession, leading economic indicators have been negative for 6 straight months, and typically we do get a recession when it happens. The yield curve is massively inverted. It's at the 80 basis point range. So again, we're talking about the 2-year over the 10-year treasury, where right now the 2-year treasuries are paying 80 basis points more than the 10-year treasury is paying. And that's illogical, right? Because if you lock your capital on for a longer period of time, you would expect to get paid more. That would be a normal scenario.
Well, it should normally be in contango.
I mean, if it was futures, yes, but it's
Okay.
kind of it's a normal yield curve, meaning like, if you're going to lend your money to the government for 10 years, you're going to expect a higher yield than if you do it for 2, right?
Yeah, exactly. And this when the yield curve gets inverted like this is usually one of the forewarning signals of a recession coming, correct?
That's right. So you can see that happening here in '89 before that recession. It happened here in 2000. That's 2006-07, 2019, and then amazingly enough, we actually got COVID, which was a mild recession, and that was before COVID. So the economy was about to fall into recession even beforehand, and now we're at minus 81 basis points. It's the most inverted since the early 1980s.
Do you see any evidence of this inversion becoming either larger or shorter on the intermediate going forward period?
Well, it has been getting slightly worse, but it's going to be unlikely to get a lot more negative than this, just because the absolute numbers today are lower than what they were in the 1980s, where the treasuries were trading in double digits. So getting to this level of inversion is difficult. It just means that the short-term rates are very, very high. And because investors are expecting them to go lower soon, the 10-year treasury is lower. So investors are expecting rates to drop in response to a recession. So they prefer to buy the long end of the treasury versus the short end. Because imagine, even if you invested in the 2-year, but then Fed cuts right back to 0, the next roundabout, you won't be able to get your 4% anymore because it will be closer to 0. So you'd rather lock in the 10-year treasury today, knowing that you're locking 10 years at a higher rate now.
And isn't that also a smarter move in the event that there's any type of decrease in interest rates? Because wouldn't your bonds then appreciate as well? So you're kind of
your bond, yeah, and you'll make money on that as well, yeah. But it becomes sort of a self-fulfilling loop because banks, for example, don't like an inverted yield curve because a bank's business is to borrow
at the short end and lend at the long.
Right, and here it's literally very difficult for them to make money when the yield curve's inverted.
Sure.
So it becomes a self-fulfilling prophecy because then as the yield curve stays inverted longer and longer, banks lend less and then liquidity dries up and it could lead to a recession on its own. But anyway, this is one of the reasons this has been such a strong signal for a recession historically. Dollar has also been rising very rapidly in 2022. And the dollar is one of the most important factors globally, as it's causing a lot of economic hurt, particularly in emerging markets. And that's also leading to that international story.
Correct. And for anybody that ever wants to understand why it affects the emerging markets, we have a whole series on the petrodollar that you can go back and watch about. It's a 3-part series. It's very interesting. And I think it's pretty essential to understanding the dollar's position as a reserve currency of the world and why why a rising dollar acts almost like a quantitative tightening for the emergings.
Right. All those loans they're taking in dollars in the good times now they have to get paid with all that increase in the debt payment.
That's correct. They need more of their own currency to get the dollars needed to be able to pay back the loans that they took in USD.
Yes. So the world, to that point, the amount of the dollar quote short position that we're in is pretty substantial, as foreign US dollar dominated debt outstanding is over $14 trillion and has risen substantially in recent years.
And so what are you trying to say here, that this is because everybody owes in dollars, that could make this rising dollar just even harder on the world? Like, what's the big
Right.
takeaway?
So imagine there's $14 trillion of dollar denominated debts outstanding out there.
Yeah.
And they have to get paid in dollars, right? So as the dollar continues to appreciate, that 14 trillion is a lot more in whatever local currencies that you need to pay it. So if you're making your income in peso, but you have to pay your loan in dollars, it's going to take more pesos to pay that same loan. And that's really why that's so difficult for emerging markets.
Got it. So then if I was Jerome Powell, I might be sitting here looking at this feeling queasy, because I might want to raise interest rates all I can all day long. But if I tank the entire global economy, then I'm going to get dragged down with it. And there goes my soft landing.
And that's why they say that, the Federal Reserve is not only the US central bank. In a way, it's really the global central bank, because they do create the global reserve currency still. And still 60% of all global FX reserves, 60% plus, are still US dollar.
Does Jerome Powell get together with the head of the Japanese central bank, the head of the ECB, and have these type of conversations before they make these decisions?
Not necessarily before they make these decisions, but they do meet. They do meet in Jackson Hole, Wyoming, in every summer. They do talk. They do communicate. I do know that the central bank.
What about in a period like now? It's like you're rising everything really quickly. That impacts them and their own decisions and impacts the world economy. Is there any type of
But for example, the Japanese central bank has requested that they slow the pace of interest rate increases multiple times, because Japan has been suffering from that, because they're sitting on a very low monetary policy. They're still at zero, and that's creating a lot of problems for them in their exchange rate. And the U.S. said no, because the U.S. is more concerned about its own monetary policy and inflation before they worry about the rest of the world, as they should. So yeah, now you start having some conflicting issues and things of that nature when it comes down to that. But yeah, that's generally why we say that a fast appreciating dollar is not very good for risk assets, generally speaking.
Okay, got it.
So long term, we'll end this with demographics. People ask, is inflation going to be with us for decades? Is inflation going to be with us for 15 years, as it was in the 70s and 80s? And my general answer is, I don't think so. And I don't think so because I think this inflationary period is a pure monetary fiscal phenomena. It's not organic. So what I mean by this is a result of just probably not the smartest policy, given what we've seen in COVID. It's not an organic period of inflation truly driven by consumption that's just massively increasing.
Could you talk about just quickly what organic might look like from just a raw population growth perspective, and maybe two, velocity of money, just so that we can all understand the difference between that world and what we pivoted to with the money printing?
Yeah, so if you go back here to the 1960s and 1970s here, what you would see is on the red, you see the age wave. So the age wave is people in the labor force ages 16 to 34. These are young people that are entering the workforce. They graduate college, they start a family, they buy a house, they buy a car, they get their, they start making real money for the first time in their life. That's organic inflation. A ton of people doing that simultaneously. Everybody's scrambling to buy homes, cars, having kids. As you may know now, that's an expensive thing and requires a lot of purchases. So all these things happening simultaneously is organic inflation. And there's a reason why the age wave was so correlated with that high inflationary spike in the 70s and early 80s. But then as it cooled down, so did the age wave. What's different now is that the age wave is still deteriorating. Population growth is very modest. The birth rate around the Western world are below replacement rate. They're well below 2.1 in almost every country you choose. So this inflationary period is not organic. It's actually driven by just policy. So it's unlikely that it will stay here for 5 or 10 more years once that policy is corrected.
Sounds good.
And we see that too, age wave versus the 10-year treasury, as 10-year treasury has been correlated with inflation. That's been that trend for a while. So that's good news net net, meaning that we're probably not going to see a period of a lot of inflation, and most likely we're going to go back to normal once this recession is dealt with, and hopefully it doesn't end up. Hopefully it doesn't end up with a catastrophic landing. Hopefully we can avoid that and have one of these economic down cycles, which is a natural. It's just a natural part of the world. It's been around since the beginning of time, really.
Got it.
And to end that, I'll leave you with this thought. Since the Dow was created here in 1896, what we've seen is multiple periods of zero returns from the stock market, followed by returns of bull market and actual price appreciation. So it's not uncommon to go through a very long period of time with just a lot of volatility and no returns from the stock market at all. That was one of the reasons we created Equi, is to have an alternative to this and to be fully dependent on the returns of the stock market. So, we've gotten used to the idea that markets always rise, but a lot of that assumption is really based on what we've seen from 2009 through current. So for example, if you invested in 2000, you didn't make your money back until 2012, 2013. So that was a 12, 13-year period of nothing. Similarly, the 1970s, 1929 to 54, etc. So it's not uncommon to have lost decades. And it's something just investors need to understand.
Yeah, and Itay, can you just quickly explain the difference between one of these logarithmic graphs and maybe one of these up and to the right S&P or Dow graphs that we're all used to seeing on whatever charts off it or chart tools that we use?
Yeah, and that's one of the things people tell you: invest in the stock market. Look at this in the long run; it's all going to be fine. So that doesn't change. That doesn't take into effect this inflation and compounding effect. So making 15% over 12 years makes the chart go exponential. But then, losing 50% on that looks the same. So the idea in a log chart, it tracks the difference between, let's say, a 5 and a 6, the same as it is between a 6 and a 7. So you really see the percentage magnitudes over time, and that gives you a real picture of how you as an investor is going to experience the ups and downs of the market. This is much more realistic, and it takes into account all these different periods. And it just shows you too, like how incredible 1929 to 1932 really was.
Yeah, that is truly an unprecedented period of time.
Right. So this is a more, I would say, genuine picture of what this means. And this is, just to amplify that almost half the time or even more, markets were in this consolidation, flat, with a lot of volatility mode. And periods of growth are great, but they're not to, an investor shouldn't count on these alone as their way of investing.
Itay, is this it? Is this all we've got?
This is all we got.
You've done it once again. I thought that was a really great recap and very excited for 2023. I know how hard you and your team have to work. When these markets are seesawing and they're slowly grinding down, it makes investing a portfolio very difficult. So, big kudos to your team. I know you guys are doing great things. I'm very happy as an investor and very excited to see what you guys are building going forward.
Thank you so much. Looking forward to for a good year end and a great 2023.
And Itay, one last important thing for anybody that is interested in getting invested with Equi or getting access to some of these proprietary portfolios that you're building, how might somebody go about doing that?
You can go to our website at equi.com and you can join the wait list. Someone from our team will reach out to you.